Hello, all. You all filled out your tax form 1040, and all of you used standard deduction. Do you remember that whatever you made, you subtracted 13,850 or something from it? And then let's say if you made 63,850, you subtracted 13,850, and you told the IRS that your adjusted gross income is $50,000. Therefore, that means you got the IRS gives discount. I use the term discount, but that's the same as a standard deduction. Just for simplicity, I use discount. Therefore, everybody, according to a standard deduction, assuming the person is, single and is filing separately, is getting, 13,850 discount. Therefore, the salary of the person who is 63,850 minus 13,850, that is $50,000, and you have to pay taxes on $50,000. Imagine 20% of 50,000 is $10,000. Just as an example, is federal taxes. Now, the question is that, is it a good deal to use a standard deduction or itemized deduction? If by any chance you can itemize, and those itemization gives you a deduction more than 13,850, then you have to itemize. Therefore, many of you won't be able to itemize because you don't have those, expenses that qualified for tax deductions. Let's see what are the taxes. Do you remember here it is 13,850, and it is jointly. If you file jointly, it is 7,000, and single taxpayers over 60 or blind will add 1850 and to their total. Therefore, as you all see, you can either use standard or itemized. Many people itemize it. Who are the people who itemize? They are the ones who have a lot of expenses in terms of medical, and they are paying property taxes, or they are paying a lot of mortgage, or they donate a lot to the charitable organization, or they have some casualty losses, and also they have moving expenses. When they add these things that are allowable, which together, if they are more than 13,850, then they will itemize because they get more deductions than 13,000, and their adjusted gross income will be less than $50,000. That way, they pay less taxes. Now, let's see what each one of these are. Let's say if I go to a doctor and, the excess of 75.75% of, adjusted gross income, which means it has a limit. That 7.5% is the limit for that adjusted, gross income. Then if I pay local taxes, then that is, tax deductible. If I have a mortgage and I am paying interest on that mortgage, and up to $750,000 of, if I have $1 million of, mortgage payments and interest on that doesn't count, up to $750,000. And then I come here and imagine I donate $1,000 to the charity, or I have some losses here, or I have some moving expenses. I put all of these together, and it will come, instead of 13,850, imagine that it comes to 23,000. That means $10,000 more than, a standard deduction. Then it is better I itemize, because it is $10,000 more than itemized. Then instead, my adjusted gross income, instead of 50,000, will be 40,000. That means I am paying taxes on 40,000 instead of 50. Do you see 40,000? If 20% of 40,000 is $8,000. Do you know the first scenario? I had to pay 20% on 50,000. It was $10,000 taxes. Now, if I itemize, I pay taxes on 40,000, which is 8,000. Therefore, I pay $2,000 less taxes. That's why it is so important you all know about these, deductions. And some people who itemize, they usually forget to include in their itemization is medical travel expenses. They put their medical expenses that limit, but they don't think about, okay, they can deduct their taxes. Let's say if I go to, let's say, Morgantown, and maybe I have to go to Morgantown, drive from here to Morgantown, maybe the expense for me is $1 per mile, for example. 70 miles, I drive 70 miles, I come back, that is 140 miles. 140 miles, for example, gives me, discount on $140. I won't pay taxes. I added that to the, itemized deduction. Some people forget about health insurance premiums that are deductible, to include that. Some people forget about real estate taxes and home sales costs. And some people forget about volunteer and donation expenses or getting college tax credit. Therefore, all of these, or you have to calculate to see which one of these, are better options. Now, I go to the next page, and exemption. Exemption is that when you fill out your W-4 form, the ones that you want to work for an organization, they give you a form to fill out. They ask you how many exemption you want to have. If you think you are going to get a lot of money back from the IRS, sometimes it's a good idea that illegally make sure it is okay to claim more deductions, because if you do that, at the very end, you won't get a big check, because you get that as an extra to your salary, your employer doesn't deduct as much taxes on you. And calculating and filing your taxes, and we go to the next page, and here is an interesting table I want you to look at here. Imagine that you are going to make, you remember that I said that your standard deduction is $13,850. Imagine you make $23,850. You use a standard deduction, means you deduct $13,850. You end up having $10,000. If you have $10,000, here you fall, according to this tax table, if your adjustable income is $10,000, which is in that category, you have to pay 10% of it for taxes. 10% of 10,000 is $1,000 you pay for the federal. However, if you make more than $23,850, then the next level, anything above 11,000, you have to pay, instead of 10%, you pay 12%. The more your money make, the rate goes up above, and therefore you can do a calculation on how much your taxes are, and you will see that sometimes the less money you make, the percentage of taxpayer money you pay is less. Therefore, pay attention to this one. The more you learn about these things, the more you can save, because one day you know how your salary structure is going to be, and sometimes you decide to keep yourself in a lower taxable income. How can you keep yourself in a lower taxable income? Is that suddenly you might, contribute something to your retirement. If you do contribute something to your retirement, do you see that suppose your salary will drop below $11,000? If it drops below $11,000, you only pay 10%. Do you see that? However it goes. Therefore, you can adjust what you get and pay less taxes. The goal is that when you file taxes, you want to file it legally, but you want to pay as less taxes as possible. Therefore, the more you learn, the less you have the potential, the less taxes you have the potential to pay. And here it talks about tax credits, which are great, much better than those things that are tax deductible. Tax credits are different from those things that you see as tax deductible, because imagine that if you have to pay $3,860 and then suddenly you get tax credit for $1,000, this is a huge help to you. Do you know why? Because you pocket this $1,000. That is different than you use something which is tax deductible. Imagine one thing we said is a tax deductible. Imagine is, for example, moving expenses. If you have $1,000 of tax deductible, that means on $1,000 you don't pay any taxes. When you look at it, when you don't pay $1,000 taxes on 1,000, how much are taxes on that? Is only $200. Do you see that? That moving expense only gives you 200 benefit. But here, this is 1,000. Tax credit is much better than impact of it, is much more and much better than those things that allow you are considered as tax deductible. I wish I had put that on Microsoft, Word. I had typed this. That way you could see the impact of it. But I strongly recommend read this and try to understand the importance of, tax credit as opposed to those things that are tax deductible. Here, there are some questions for you. Go and try to see if you understand these and if you can answer that. Therefore, this is an excellent chapter. I know many of you like to make money. Many of you like to be wealthy person. Many of you are interested not to pay taxes to the IRS. Therefore, the more you read about these chapters, the better it is. Estimates and extensions, Extensions is that in April 15, you have to file, mid-September, April, you have to file your taxes. Imagine that something happens and you get so busy, and imagine you don't expect to, owe any money, a lot of money to IRS. You go and fill out a simple form, it is called extension. In that form, you say, these are my taxes. It's just you put two, three numbers, your name, your social security, your address, and how much you think you might owe. And then you are asking for extension. You are telling the IRS, I am busy, please give me, 2 months, 3 months, 4 months, That way, after 4 months, when I am not busy, I'm going to file your taxes. Of course, if you owe a lot of money and you are late, you have to pay, of course, either during the time of extension, you have to pay some of the things that you think you might owe, or if you wait and, file it later on with a lot of money you owe to the IRS, then they will add interest or maybe penalty and those things. And we know filing that you are available, you know that usually April 15th is the time that you have to file your taxes, extensions and amended returns. Sometimes you might make a mistake. When you make a mistake, you put an amendment, which means you have to return. In fact, I am going to put an amended return for my this year. I had claimed something and later I found out I was not supposed to do that. Because I felt I was not supposed to do that, I have to file an amended return. And by doing so, I say, I made this mistake. And of course, I have to put a check for the IRS and the tax, because I use TurboTax. It calculates how much penalty I have to make to give to the IRS. I have to pay to the IRS because of a mistake that I have done. But I am happy that I could cut it myself. It's much better than, the IRS catches me, because if the IRS catches the person, they think you have been cheating. But when you do it, you find out something is wrong. Or maybe you paid extra to the IRS. Therefore, you can amend it and give it to the IRS, and then in that case, IRS would give you a return. But remember that amendment is not necessarily means that you have to give extra money to. If you make a mistake or something comes and it's different, then you have to amend it, talk to your accountant, or you have to, if you use software, you can do that. Then you come here, audited return, and it is another subject, that will, you may increase the probability of a tax audit, an interesting subject. Therefore, how can you stay under radar to, not to be audited? The people don't like to be audited because many people, most of the people, almost, a lot, everybody is honest. But usually when you are audited, you have to, take it easy and, remember that, try to be honest and try to, be prepared. And if you have a high income, if you are a high income person, 1 million and more, Therefore, you have the possibility of being audited. Discrepancy in reported income. Imagine your employer tells that this person to the IRS made 100,000. On your tax form, you claim that you made 50,000. There is a discrepancy, higher than average deductions. Of course, I saw those of you who filled out your forms, you didn't use deductions, all you used standard deductions. Those who itemize, sometimes they might go and say, oh, we had about $50,000 of medical expenses, $100,000, $2,000 of moving expenses. Therefore, IRS can become a little bit a red flag, These are the computers that sometimes, home office deductions, which means the people sometimes claim that they are using their home as their office. They use that as, large business expenses. They say, I travel a lot. We have spent a lot of money on meals and business use of vehicles. Suppose you have your own car and you try to say that, oh, this car that I have used all of it for the business. Therefore, of course, as I said, you use this deductions if you are itemizing. And as I said, all of you deducted your taxes based on standard deduction. Unreported foreign bank accounts, although you haven't had many of you, I'm assuming you don't have foreign bank account, but you have an account in Mexico, $100,000, and you are making a lot of interest on it. You are supposed to tell the IRS that you have a foreign account and that's your income outside the country. Even sometimes the banks, usually they have an agreement with the US government, the banks in Mexico. If you are making some money, they will report it to the IRS, claiming earned income credit. And this is a credit that sometimes the people get and make a mistake. And lots of rounded numbers. Rounded numbers means that you say, I made $100,000. I had $20,000. Do you see 100,000 is a kind of rounded number? Then you say, I had $20,000 worth of deductions. I paid them, I don't know, $5,000 for all these numbers are rounded. The computers recognize it, and that increases the possibility of being audited. And tax preparation services, help from IRS. You go to their website, private tax preparer, CPAs, you go to CPAs, and we will talk. This is another subject I will talk. EIN, this is when you start your own business. You will go and you will, get an EIN, for your business and employer identification number. It is just like the Social Security. And we got computer and online-based tax return, which are very great these days, TurboTax and H&R Block. Therefore, these are two very popular ones. And guess what? I noticed something has happened in the state of West Virginia that is going to happen in the future in state of West Virginia as well. In California, residents of the IRS has created something on its website that is exactly like TurboTax. Those people are lucky. They go there and they fill out. Suppose for TurboTax, I had to pay $200 every year to file my taxes. And however, those people who are in California, they go to the website of the IRS and they file their taxes without paying because the software that the IRS has provided to the residents of California and several other states, the same software is as good as TurboTax. The IRS is, doing it as a beta version. That means they are just testing the market and they don't want to roll it over to all states. But I have a feeling in the next few years, we are going to have a great software from the IRS that we can do it in the state of West Virginia. That is, choosing a tax preparer. A IRS website has some recommendation. Electronic filing is a great idea. And tax returns, let me go to the next page and see effective tax planning. Oh, tax evasion. That's a major problem. The people who try not to pay taxes and tax avoidance they try to stay, therefore, key objectives of the tax planning is that this is very important, is that when you are filing your taxes, you have to see what you can do legally to reduce your taxes or shift your taxes or defer your taxes. Deferring taxes means rather than paying your taxes this year, you contribute a lot to your retirement And then when you contribute, that means that you, instead of paying the taxes to the IRS, you are putting it in your retirement account. Deferring it means after you retire, then you can go and get that money and give it to the IRS, which is a smart idea. Imagine, let me give you one example. Imagine that rather than paying $10,000 to the IRS, today, you go and contribute your salary. You make $80,000 and $10,000 of it were taxes. You'd rather than giving it to the IRS, you contributed big portion of that $80,000 to your retirement. Therefore, you won't pay that $10,000 taxes. What happens is that $10,000 extra money stays in your account, stays in your retirement account, and what you can do is that put that money in an interest. You already learned about money markets. You already learned about CDs. You already learned about things that put it in that account and let that earns interest. If that $10,000 earns interest $500 a year, why not? $500 in 1 year, a lot of money. You earn it this year, you earn it next year. That 500 until you retire is going to, compound. And suddenly that $10,000 that you didn't give now, when you retire, that $10,000 suddenly would be $50,000, and that's a lot of money that all happened because you did a smart thing by, deferring those taxes. We will talk about those when we get to 401k, IRA, and all those, tax deferred concepts. And some popular tax strategies, and the year that bonds are redeemed for cash, there we will talk about bonds, that maturity of them, and maximizing the deductions and, income shifting. These are good subjects. And we talk about tax returns and financial planning process. I want you to read, I know that it's a long lecture and I don't want to, and this is a summary. Therefore, we want you to learn about taxes as much as you can. We are offering a course called Income Tax Accounting. Many accounting students take that course, and many business students are taking, and some of the students in this class most likely are taking that class with Mrs. Murphy. I strongly recommend, the more you learn about the taxes, the more money you are going to get, happier you are going to be, and the less possibility of being audited, and the less money to give to the accountants, Therefore, it's a great way of saving money. I know many of you go to the accountants, but try to see if you can use software, and also double check, try to learn as much as you can. The more you learn, I filed my taxes for almost 30 years, I would say. And I never paid any money for 30 years to accountants, for example. If every year I had to pay $200, you multiply that $200 by 30, that would be $6,000. I didn't pay accountant $6,000 in the past, and $200 of 30 years ago, you know how much it would worth today. Therefore, that $6,000, if I have invested that would be $10,000-$15,000 of money investment, because but it's always good to make sure, because the benefit of going to accountants is that sometimes they might find good ways for you to save money. That doesn't mean necessarily it's a bad idea to see accountants, or as I said, these days just I don't have time to file it with pen and paper. I am using TurboTax, but I know I try to know as much as possible, because that saves me a lot of money. And that's why we want you to learn as much as possible. Read about this chapter. There are some problems solved by the chapter. Read and understand tax brackets, and what the differences between. Many of you will benefit by a standard deduction, but some of you, they itemize. Therefore, your parents might itemize, when they go to their accountant. My recommendation, those of you, parents, go ahead and look at their taxes. See, their tax returns, find out about how they itemize. Maybe give them some advice, and, it's a great subject to learn, because it's a very important part of personal finance. One thing I want to mention is that, just think about it, is that if you make $100,000 a year, out of $100,000 a year, almost $30,000 of it, goes for taxes. And that is a huge amount of $30,000, 30% of our money usually goes for taxes. What kind of taxes? Income taxes, social security taxes. Those are something that sometimes we cannot avoid, social security taxes, or, insurance, retirement insurance taxes, and other things. How nice it is if we are smart enough not to let the IRS get that 30,000. Of course, some of the taxes we pay are sales taxes. We have no other choice. You go to Walmart, you buy something, they have a sales tax. Those are something we have to pay, and we have no other choice and control over it. But these taxes, that we will talk in the future, talk about the retirements and see what we can do to pay as least as possible. That's the trick. Not to pay as much legally, not to pay the IRS. Find ways and keep that money in your own pocket. That's a smart way of, and that's even IRS wants you to do. We will talk more.